Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Somehow, I can't stop being excited about this company. Likely something to do with the fact I basically have a job researching it all day. It feels like Tesla have been laying down the seeds for this company and they're finally starting to sprout. The main one we're seeing come through right now is 4680 cells in production in a new factory. Tesla no longer feels like one of those companies that is reliant on some major ifs or hopes. Tesla are already there, at least when it comes to making electric cars. We're still a little unsure about FSD. Luckily, in the past, we've done plenty of models that value Tesla as a pretty big company, even without FSD. Of course, FSD is the big ticket. However, all the exciting Tesla headlines are somewhat being diluted by market crash and economic doom headlines. However, when you look at the causes of all the economic situation, then Tesla is actually positioned quite well. For starters, what is the main issue right now? Well, we had inflation coming already, then a war jumped on top of that, and we saw oil prices spike. Higher oil prices add to everything in the economy. In other words, more inflation, yet workers' wages have not yet caught up with this new inflation, which means their cost of living has increased, which means they have less money to spend in the economy, which brings down aggregate demand. Although all products are affected by oil prices, obviously gas at the pump is more directly felt. It now costs more to fill up your gas tank, resulting in less expendable income again. If inflation and higher oil prices aren't enough to make you want to cut back on your spending, well, interest rates might be. They've increased and will continue to. This reduces aggregate demand in the economy again, as it costs more to borrow money to buy things, and the opportunity cost of income from cash is higher, as you earn a higher interest rate on your money. Of course, this will affect mortgages too. When mortgages come up for renewal, they'll be at these new higher interest rates. This will have a major impact on a lot of homeowners. Anyway, as a result of inflation, oil, interest rates, everyone has less expendable income, and the income they do have now has less purchasing power, as in the money won't go as far as it used to. The high oil prices are a result of supply and demand. Therefore, they can be eased by increasing supply or reducing demand. All of what we just mentioned before is certainly reducing demand, as people simply have less money available to buy more stuff, and in theory, that should reduce the cost of oil. But then we have supply. It looks like crude might be tight for years. This year, they're releasing 1 million barrels a day out of global strategic reserves. I'm not sure what replaces that next year, Iran or Venezuela, or we crush demand due to high prices. This is not the first time the world has experienced an oil crisis before. In the Tesla community, everyone likes to talk about the oil crisis in the 70s, and it's often talked about in reference to how the Japanese vehicles came to America, and then as a result, people in the community think that the Chinese electric vehicles will invade the US, which is total nonsense. As a result, the US had to reduce their domestic oil consumption, and Nixon passed the National Maximum Speed Law, where the entire US had speed limits of just 55 miles an hour. Nixon believed it was a more fuel-efficient speed to drive and would thus save on gasoline consumption. Other nations were suffering too and taking various strategies to reduce their dependence on oil, such as in New Zealand, you had to choose one day a week where you weren't allowed to drive your car. In addition to that, everyone is also suffering from these high gas prices, and I know Americans are suffering with significantly higher gas prices than they were used to, but the thing is, America has cheap gas compared to a lot of the world. A lot of people are spending over $100 a week at the pump. Well, one way to entirely alleviate the pain at the pump is to avoid it altogether and simply go electric. In other words, right now, people are more incentivized to look into electric cars solely for the cost saving at the pump. Consumers are always very motivated to purchase products that save them money. Sure, the people hurting the most cannot afford a new Tesla, but the people driving around in big V8 SUVs, well, they would save quite a bit by changing over to a Model Y. So even if overall aggregate demand for EVs has dropped, it wouldn't have dropped as much as demand for ICE due to this extra potential demand of consumers not wanting to pay high gas prices anymore. However, the EV market segment was already growing at quite a rate, so it's possible now the cost of ownership of an electric car just became relatively cheaper, and demand for EVs may even increase. And even if it hasn't, then as far as Tesla is concerned, they are better off than absolutely every other auto OEM on the planet. So if it does get so bad for Tesla that they actually have to start dropping their prices and still making good profits, well, it will likely be short-lived, as all the other auto companies would no longer exist, as they would have gone under, thus resulting in demand returning for Tesla due to less supply. It's just a solid position for Tesla to be in, especially with oil prices being part of the reason we're in this situation. Just to repeat, if things get so bad for Tesla that demand drops, It will mean there'll be fewer auto OEMs left when they come out of the other side. But what if governments actually want to try and force this? More EV adoption in order to reduce demand on oil? Well, you and I know that governments can't really make EVs happen any faster, but I don't think they know that. So it is possible we could end up seeing a rebate still, particularly with the incentive of reducing ICE driving. All it will actually do is make EVs more expensive and longer waiting lists, at the taxpayer's cost. But if Tesla's demand ever did start to drop, this would certainly pull it back up. Who knows how desperate the government might get? They may even allow robotaxis next year or something. Why? Because a robotaxi replaces the driving of 5 ICE cars, 5 less cars wanting gas or depending on oil. It might take some sort of black swan event like that to accelerate robotaxis. It might be economically beneficial to have the robotaxis. And of course, I'm sure you've just heard about Tesla yet again raising the prices of their vehicles. The Model Y long range is now an additional $3,000 at $66,000. Of course, these new prices only apply for new orders. The Model Y has an expected delivery date of around January to March 2023, so it wouldn't be until that time when these new prices are noticed in the financials. Now, I know we think this is to do with inflation, and they even told us on the earnings call that due to such a long waiting period, Tesla have to try and calculate future prices this far ahead, which is especially difficult when you're trying to factor in potentially massive inflation. But this is a 10% price raise, as in the price of the car has been raised about 10% from what it costs to build. As in costs would have had to have risen 10% over a year for these price rises to generate the same profit as before. I don't think Tesla's costs are going to increase 10%. In fact, if anything, they may even have come down by then. I expect commodity prices to drop, and of course, new manufacturing techniques to reduce costs. In my opinion, this is more of a price rise due to demand, not inflation. Tesla might be expecting a ton more demand with higher oil prices now too. Even if the price rises are to cover inflation, then Tesla's profits are still also increasing with inflation. As in, perhaps Tesla made 30% on a $60,000 Model Y with $18,000 gross profit. Well, now they make 30% on a $66,000 car, making $19,800 profit. Do you see? Either way, Tesla's profits increase. This is gross profit too, of course. The further down you go, the larger it is felt, i.e. a larger impact on net profits. I also think these new prices are here to stay, because if Tesla dropped the price, then almost everyone would cancel their orders and reorder at the new lower price. So if Tesla was to ever drop these prices now, it would be if the waiting list was very short, as to not lose too many orders. I think it's got to be a good sign that we're headed into a recession and raising prices. It just shows how strong demand is. It also makes the Austin Model Y look like even better value now. I just feel like Tesla is in such an excellent position, despite the economy not so much. But anything that is thrown at Tesla will be significantly tougher for any of the legacy autos to face. I just don't think demand is an issue that we need to concern ourselves so much with Tesla. And all those other Tesla owners listening now likely nodding their heads as they know how impressive the product is. Even through an economic downturn, I don't think Tesla will have any demand problems. At least not the way this recession looks to be headed. But it's always good to check. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.